about Interglobe Aviation, a tad under pressure despite reporting a very strong set of numbers in the first quarter. What exactly is happening? This is our special Value Plus segment. Sonia, the results were that of a takeoff, but then there is some turbulence.
Okay, as long as there's no crash landing for the investors or viewers, right? But just a couple of points why the stock is under pressure. One, it's a sell-on news sort of situation. So let's not forget that the Interglobe Aviation stock has had a phenomenal run. Since March of this year, the stock is up almost about 40-odd%. And there are some risks on the horizon in Q2 because of which perhaps profits are being taken off the stock. So one of the risks is higher fuel prices. So since the last quarter, fuel prices have risen. And remember, in the quarter gone by, in Q1, the fuel prices actually fell 22% year-on-year for the company. And now in this quarter, fuel prices have risen. So that could be a bit of a risk for the margins. Also, the yields have been lower in Q1. And Macquarie put out a note saying that the near-term yields are also expected to be on the softer side. The other issue is what's happening with the Gangwal family. Now, remember, the Gangwal family still holds nearly 30% in Interglobe Aviation, and they could sell further stake going forward since the 5-month lock-in is over. So that's another overhang on Interglobe Aviation. So these are a couple of reasons why the stock is under pressure. Having said that, there are still many positives. So there are both bulls and bears on the street. It's seasonally been a very strong quarter for them. And now Interglobe is focusing on the international market in a big way. Indo-Europe travel is seeing a big boost, and the company has a code-sharing agreement with Turkish Airlines. In fact, they're planning a phased entry into the US market as well, using the Istanbul stopover. And we all know that Go First issues have created a big supply vacuum, which has led to Interglobe Aviation getting higher market share. Now they enjoy over 70% market share in a lot of the monopolistic routes. Apart from that, Indigo has also maintained its FY24 capacity guidance of above mid-teens, around 40 to 50 planes, and they expect their own capacity to be up by 25% year-on-year in quarter 2. The other positive is that the Pratt & Whitney engine issues that they had, it has had basically no impact on Indigo's capacity plans. So there is a bull and a bear case scenario, but you can take your pick. We will provide you some information from the management as well. Here's Peter Elbers, the CEO of Indigo, talking about the way forward.
Take a little bit of a step back at COVID. We had pretty much 10 quarters of consecutive losses. By the end of, actually by the middle of last year, as from the third quarter, we're back into profitable territories. So now for 3 quarters in a row, we're back into black numbers, black figures. This combination of a strong market on the one hand side and a lot of initiatives, including a very strong operational performance, are really helping us in creating such a good result. We're not making any prediction what's going to be the precise result next quarter, and there's always some seasonal fluctuations in the results. Indigo is focusing on develop our own company. We have a steady flow. Today, I think we communicated that we're having around 40-ish aircraft, which of course is driven by the supply chain. In addition, and that number is actually pretty stable over the past time. That most recent announcement of the first batch of 200, I mentioned a single number or single-digit number actually for Indigo, so that for the weeks and the months ahead will not have a very significant impact. Those are the numbers we can deal with within our capacity guidance. We don't know yet precisely what's going to be the next phase of the Pratt inspections to take place.
Okay, so that's the management of Indigo. We need to take a short break with the news.